Hello everyone. Friends, we are again with a new topic today, and as you can see we are going to start valuation of securities. So specifically in this video we will be discussing valuation of shares, but in the following videos we will be discussing about the valuation of bonds. Now before I start directly discussing how we value shares or discussing the different models of valuation of shares, I would like to tell you two basic things which is very essential to understand this concept. The first thing is that when we are an investor, we would like to see what is the price of a share, right? We talk about share only in this video. So now friends, now this depends upon the value of the share. Now value has got two components. One is your intrinsic value and the other one is the market value. So friends, market value means the share, the price that is reflected in the market that displays the price of that security. That is known as market value. So a security X, how much is its value in the market as displayed by the market or as displayed by the performance in the market. Right friends? So I find that the value of this share as in the market is 250. The price is 250. Right friends? Now we must have to see that what is its intrinsic value. Intrinsic value means what is its true value as represented by its worth. Right? As represented by the benefit that this share is likely to give me. So this is what the market is saying, that this is the value, and you know market is dependent on demand and supply, and that determines rupees 250. But when I say intrinsic value, it represents what is its real worth, what is the benefit that this share has the capacity to offer to the investors. So friends, we need to compare the intrinsic value and the market value. So suppose the intrinsic value of the share is 300 rupees. So you can compare that the market value is 250 but the intrinsic value is 300. So that means your share's original worth is more than what is reflected in the market. That means this particular share is underpriced in the market. The share is been priced lower as what it deserves. So there is a chance that the price will go high because its intrinsic value is higher, and therefore in such situation when your market value is less than the intrinsic value, you need to buy more and more shares because this share price is going to become higher and higher. Right friends, now let's move on to if a situation comes when its market value is 250, right? The market value is 250 and its intrinsic value comes to be rupees 200. So in that case, your market reflects a higher value than the actual worth or the benefit that the share is likely to offer to the investor. In this case, I would say this particular share is overpriced. The market is reflecting a higher price. So that means that there is a chance that the share price will fall in order to adjust with its intrinsic value, and therefore you need to sell off the shares with the anticipation that the price will fall in the future. So friends, how will I know what is the intrinsic value of the share? I know what is the market value of the share as I can see the market performance of the share and know what is the current market price of the share. But I cannot tell or I cannot find out the intrinsic value of the share simply like that. For this there are certain models, and that model we are going to discuss in this video with special reference to the shares. Now friends, as we have understood what is the intrinsic and market value, so one more thing I would like to specify here, that your intrinsic value is equal to the market value. But if there is a disbalance, they are not equal. In very short run it may be possible that they are not equal, but in the long run they tend to become same. And this adjustment when there is a disbalance means the shares are either underpriced or overpriced. So that's all about the intrinsic value of the share. And we will be covering what are the ways by which we discover the intrinsic value of the share. Now friends, another concept I have to tell you before I start directly the models. So first I have explained you the intrinsic and market value concept. Now we move on to another concept that we have already discussed, that is the time value of money. Now friends, we all know that the money that we receive in a future period always carries a less value. Because if I give you 100 rupees today and if I give you another option to receive the same 100 rupees after 5 years, you would prefer to receive it today. Because with time the value of the money that you receive gets discounted, right? So that means if your shares, whenever you buy a share, there is an expectation that you get some return out of the share. Suppose you get dividend out of the share. So whenever you get dividend out of the share and this share you are holding for year 1, year 2, year 3, year 4, this dividends you are receiving in the subsequent time period. So as you receive the cash dividends in successive time periods, the value that you receive the cash in the successive time periods today should be discounted to get its true worth. So if somebody says I will receive 5,000 dividend every year, so that means the 5,000 dividend that I receive today, its value will certainly be higher than what I receive after the second year, third year, fourth year. That's why I have to reduce its value to adjust the time factor, and that reduction in the value of the receipts is known as the discounting or known as the time value of the money. So friends, I have a big video on this, an elaborate video. You may refer to it whenever possible. So for time being, we just have to remember two things, that we have to discover the intrinsic value of the share. Why? This will give me a guidance, or this will provide me a direction whether I should buy the share or sell the share, because I need to know whether the market price is showing high or less, whether the shares are underpriced or overpriced. This is one. Secondly, I have to know that whatever receipts I get because of my investment in shares, this is coming in future time period. I need to know its true worth today, and that we do by discounting, and that is known as the time value of money. Having given this concept, let's move on to discuss how can we decide the intrinsic value of the shares. Now friends, when we discuss the intrinsic value of the shares, there are certain models that we have to understand. So for example, I need to know what is the value of the share, the price of the share as 0, right? So here, what is this value of the share as represented as 0? Means this share is going to give me the dividend, say D1. Suppose I hold it for, suppose I take a case 1, that I hold it for 1 year. So holding period of 1, holding period is equals to 1. I held this share for 1 year, and now I would like to see what is the value of this share. Now if I want to know what would be the value of the share at the end of the holding period, that is end of the year 1, then I should know that this share will give me dividend, right? So D1 at the end of the period. Plus, since I am holding it for 1 year, so after end of the year, I will sell the share and get some value. So, I call it sales value S1. Why I am saying 1 and 1? 1 and 1 means after completion of 1 year, I will get some dividend, and of course, since I am holding it for 1 year, I will sell it and get some value. So, that is the sales value after 1 year. Right friends? So, that will tell you what is the value of the share at this point of time as 0. But remember friends, the dividend that I will get will be after 1 year. So today at 0, time 0, I am trying to find out at the end of the first year, okay, time 1, that is 1, what would be its value. So obviously, after 1 year, its value that I see will carry less value than what is its value at 0. So at 0 and at 1. The value at 1 will of course be less than what is the value today at 0 point. So I need to discount the value, and that's why, as you know, I have to discount with 1 plus r to the power n. Please refer to the previous video on time value of money. You should know that this is the value of the cash receipts divided by the discounting factor. And what is the discounting factor? 1 plus r. R means rate of interest in that case. But here it will be K. K means what is the return for the shares. What is the KE means what is the discounting rate. Okay, so to the power 1. Let me explain what is K. K means how much is the return that the shareholder is expecting. Okay, that becomes our discounting factor. Because when I have put my money in shares, I can put the same money in some other investment avenues. But since I have not invested in those avenues, so I am trying to get the opportunity cost, right? So the opportunity cost is K. So this is the discounting factor 1 plus K to the power 1. Why 1? Because I have kept the money for just 1 year. Similarly, what I get after end of the year is 1 plus K to the power 1. So that will give you the value of the share. So friends, it's very simple. You just have to know that as I hold this share for 1 year, at the end of the 1 year I will get 1 dividend, and at the end of the year I will sell and get some value. However, this value what I get after the 1 year is a future value. I want to know its worth today, so I have to discount it. Now how will I discount rate? There will be some rate at which I should discount, and this rate is known as KE, or we can say KE, that means equity capitalization rate, or in other words, what is the cost of equity, cost of share, cost of equity share. So this becomes a discounting factor. I discount with this value, and since it is for 1 year, so I raise it to the power 1. But in case 2, if you hold it for more than holding period is for more than 1. So you have kept it for say 5 years or n number of years. So the same thing what you can see can be done for the many years. So I want to know its value today. That's why 0, S0, value of the share. D1 you will get, of course, divided by 1 plus KE to the power 1, plus I will also get D2 at the year ending 2. Second period ends, I get some dividend. 1 plus KE to the power 2, plus D3 divided by 1 plus KE to the power 2, plus this way I will go for DN, nth period, 1 plus KE to the power n. So friends, what we have done? We have simply summed all the dividends, and at the last year what we are doing? See, I will hold it for some particular period. So suppose it is the nth period. So in the last year I will sell it Sn divided by 1 plus Ke to the power n. Right? So this I get in the last year, dividend as well as the sales price, but all the other years I get only the dividend. So if I have to write it in a notation, so it is sigma, I add all these, S0 is equals to sigma, sorry not I, so let's call it T. T is equals to, so that is T period, T ranges from 1 to n, right? And what I am summing up? I am summing up all the D1 divided by 1 plus Ke to the power T, right? So when I sum all these, I get, sorry, this will be sum of all the DTs, and discounted with 1 plus Ke to the power T, okay, dt, so Ke to the power T. So that means this is a case when we are holding the security for, or holding the share for more than 1 year or for multiple period. So multiple periods dividend discounted and the last year sales value discounted. So it will be sum of all the DTs divided by 1 plus Ke by to the power T. Right friends? So this is about case 2. Now friends, do you believe that the dividend rate will always be same? If dividend rates are same, then it's fine. Okay? But the company has some such models where dividend has a growth. What we get dividend today, next year there is a chance that this rate of dividend will grow. Next to next year it will grow further. So if this dividend is growing, okay, it's not constant, then this model will not work. For that we will move on to the next case when there is a growth. So growth model, let's talk about the growth model. I think these two are clear. Now we move on to the growth model. So friends, we have come to the third case when there is a growth in the rate of dividend. Now remember friends, the growth can be of two types. One is constant growth, or it can be a varying growth, varying or you can say multiple growth. Now friends, let's understand the constant growth. Now when I believe that the dividend will grow with a rate, so let's call the growth rate to be G. It is the rate at which the dividend will grow. So how do we calculate in this case? Case A, the S0 will be equal to, say I believe that I will hold it for more than 1 year. So what I will get is that I have to first find out what is the dividend at period 1. So dividend at period 1 will be, so friends please try to understand, this will be D0 means what we get at the period 1. What is there? The current dividend plus 1 plus into 1 plus G to the power 1 divided by 1 plus K to the power Ke to the power 1. What does this mean? This means this is your dividend at the end of period 1. Dividend at the end of period 1 is what is the current dividend prevailing in the company multiplied by a growth rate 1 plus G to the power 1, because you are going to get this dividend at the end of first year, divided by 1 plus Ke to the power 1, that is discounting this for the first year, plus you get D0 1 plus G to the power 2 divided by 1 plus Ke to the power 2. This is your dividend at year 2, means end of the period 2. So again the current dividend, and you multiply with the growth for two periods raised to the power 2 and discount it for the second period. This way you go for the third one, D0 1 plus G to the power 3 divided by 1 plus Ke to the power 3. This will be your dividend for period 3. Right friends? Likewise, I will go to the last period, that is D0 into 1 plus G to the power n divided by 1 plus Ke to the power n. So that means what we are doing? The current dividend is expanded with the growth rate. Current dividend expanded with the growth rate, and this growth rate, okay, as you can see is 1 plus G. 1 plus G is a constant growth rate, and it goes on for n number of years, and we are discounting with the appropriate rate, right? So that will give you the value of a share with a constant growth rate. There is a growth in the dividend, but the growth rate is constant. Now friends, as it goes on for infinite number of years or infinite time period, ultimately we get S0 is equals to D0 times 1 plus G divided by Ke minus G. So this is the model, and also known as the Gordon's model. Gordon's model of valuation of share with a constant growth rate. So what is the ultimate thing? D0 multiplied by 1 plus G divided by Ke minus G. Okay, what is Ke? The cost of equity or the discounting rate, and G is the growth rate. Now as we operationalize this particular model, there are 3 assumptions that we have to make. The first assumption is that, remember, Ke should always be greater than G, means your cost of equity should always be greater than the growth rate. If it is not so, then the results will be absurd. Next, remember, your Ke and G is constant. We believe that it is constant. It's not varying. Right? And the third thing is that dividend at year 0, dividend at period 0 should be more than 0. That means your first dividend should not be 0. If it is 0, then the entire value becomes absurd or infinite. Right? So that's why these 3 assumptions are important if you have to operationalize this particular model. So friends, this is all about the constant growth model, where we assume that the growth is constant. Now let's move on to the multiple growth model. So friends, let's understand the multiple growth model. In the multiple growth model, we have to understand, it is based on the assumption that there will be a two stage of growth. Okay. The first stage of growth will be the dividend will grow at a varying rate. The rate is not decided. Okay. Varying rate. Whereas in the second, the dividend will grow at a constant rate. Okay. So this is the assumption of this particular multiple growth model. So actually it is quite a very natural phenomenon that a company may have extraordinary growth at the initial period, but after a particular stage the growth becomes constant. So if I divide the timeline like this, so this is the period where the company exhibited extraordinary growth, I call it at stage 1, and this is the stage 2 where the company has grown at a constant rate. And let's call this period as N period, right? Now friends, if it is a varying rate, the dividend is paid at a varying rate. Let's understand how we have to find out the value of the share at S0. Value of the share at S0 is how much the dividend is paid on the first year divided by 1 plus KE to the power 1 plus how much is paid in year 2 divided by 1 plus KE to the power 2. That is what we have discussed, right? Because we have to anticipate what is the dividend for the first year, end of the first year. We'll find out what is the dividend at the end of the second year. Plus we can go for this way, dividend n divided by 1 plus ke to the power n. So that means this period, this is the first period we are talking about. So this period I can write sum of dt divided by 1 plus ke to the power t, where t ranges from 1 to n, right? This part is done. Why it is varying? Because see, I don't know what is dividend in the first year, second year, third year. So I don't have a common form in which I can express. So I have to find out the first years individually, second years individually, and this way till I reach the period n. Now after n, there will be a constant growth, and we know for constant growth now we are talking about Sn. So Sn is equals to Sn is what? Sn means this period. If I have to find out what is the value of the shares at this period, okay, and we are taking into account all the period from n to the infinity. So what we are doing at this period, we are going to do like this. This is a constant growth model. We already know in the constant growth model we have dn, dividend for the period ending n, into 1 plus g, you know this, just now we have done the constant growth model, divided by ke minus g, right? So we get what is the value. What we are doing here, we are trying to find out what is the value of the share at the period n. But friends, we are taking the decision at period 0, and this is the value that I derived for the period n. So I have to find out what is S0 here. So S0 means I have to discount this value till this point, because here I found out at period n this is the value of the share, taking into account the dividends that I will receive at a constant rate in the future period. So that means what I will do here, for S0 I have to write dn 1 plus g to the divided by ke minus g into 1 plus ke to the power n. Okay. So that means we got its value at period 0. Now friends, that means if I add these two, I get what is the value of the share with a multiple growth rate. So ultimately what we get S0 is sum of this, sum of t is equals to 1 to n dt divided by 1 plus ke to the power t plus this part dn 1 plus g divided by ke minus g divided into 1 plus ke to the power n. So friends, in understanding this is not very difficult. We just have to know what is the constant growth rate model. Constant growth rate model is represented by this form, where we get dividend multiplied with the growth rate ke minus g. But remember, in the constant growth rate written model we wrote d0 because we are talking at this point. But when we are discussing multiple growth rate, the constant will take place only after a period of time. So after the period means n onwards, means n plus 1 year, and we are discussing this. So that means we need to discount the every receipt to period 0, and by discounting I get what is the value of the share taking into account a constant growth rate after n plus 1th period. So this way we have done this part, and this part is what is the value of the dividend or value of the share if you have a varying rate of dividend. So if it is varying, as we have done in the second case, case 2, when we have multiple dividends received for more than one accounting period, more than one holding period. So if you have dividends received for more than one holding period, find out the dividend and discount with the appropriate rate. So when you sum this all, you get T1 plus T2. That's the value of the share at the end of the, at the period 0. So friends, we have understood what is the model for valuing share under the constant growth rate and multiple growth rate assumption. Now there is another concept called PE ratio, or we have another approach, as this is a growth model. We have another model, we call it as multiplier model. So friends, we have another approach, as I have already told you, that is the multiplier approach. This multiplier approach was propounded by Wittbeck-Kaiser model, also known as Wittbeck-Kaiser model, propounded by Wittbeck and Kaiser. So what is the multiplier approach? Here we are making use of something, an accounting ratio that is known as the price-earning ratio. Price-earning ratio. So what is the formula of this ratio? Also known as PE ratio. The PE ratio formula is share price divided by earnings per share, EPS. EPS stands for earnings per share. So friends, if you have the price earning ratio given to you, say 20%, and if you know what is the earnings per share, 360 rupees, you can easily find out what is the share price. So price earning ratio becomes a kind of multiplier. So if you multiply PE ratio with the earnings per share, you get the value of the share. That value is considered to be the intrinsic value of the share. To compare with the market value to find your share is underpriced or overpriced, and take the appropriate investment decision to buy or sell. Now friends, problem is, how can we know the price earnings ratio? Generally the price earning ratio is given in the dailies, newspaper dailies, or some other documents which can be taken care of to decide what is the price earning shares. Earnings per share is also available, so you can easily calculate what is share price. But in order to correctly know or estimate what is the price earning ratio, all that we can do is that we represent a model as propounded by Wittbeck-Kaiser model, June 8, 1962. He represented it in the form of a regression equation. So this is a regression equation. This is multiple regression. So here what we are doing, we are trying to find out the impact of all these independent factors on price earning ratio, which is the dependent factors. So that means P is expressed as a function of all these. Let's understand what is this. This is earnings per share. That means if earning per share increases by 1%, then the price earnings ratio will increase by, if 1% increase in earnings per share will cause 1.5 times increase in price earning ratio. I repeat again, if my earnings per share is 300, I multiply with 1.5, it will show what is its impact on price earning ratio. Similarly, this is the dividend payout ratio. So a 1% increase in dividend payout ratio will bring 0.067 times increase in price earning ratio. If my dividend payout ratio is 20, I can just multiply 20 with this and find out what is its impact on PE. Next comes the standard deviation of the growth rate, means variation in the dividend growth rate. So if the dividend grows by 1%, if there is a change in the, if the growth rate variation increases by 1%, it will have a negative impact on price earning ratio by 0.2%, means PE will fall with the variations in the growth rate of the dividend. Now friends, if I can find out from the company's annual reports what is the EPS, find out what is dividend payout ratio, and also find out the variations in the growth rate of the dividend. I can successfully, with a constant, this one is a constant, I can successfully calculate what is the price earnings ratio. So friends, with the help of P as a multiplier, we can find out the value of the share. How to estimate P? There are different ways. You can follow this model, multiple regression model also. These are the coefficients. So these are the established coefficient as per the model, and then we can find out what is the price earning ratio. Having found the price earning ratio, you can just multiply it to know what is the share price. Friends, that's all for the valuation of shares. So we have successfully completed our discussion on how can you value a share with an assumption that we hold it for 1 year, with the assumption that we hold it for more than 1 year, with the assumption that there is a growth rate in the dividend, with the assumption that there is a constant growth rate, and lastly with another assumption that the growth rate is not the same. So friends, this is all from my side. Let's meet again with another video on the topic valuation of bonds. Till then, goodbye and take care.